Let's get straight to the point. The markets are manipulated against you. Every single day the market is manipulated in some type of way, and it's meant for the average retail investor like you and me to lose money. If you are losing money, it's by design, not by luck. While your balance is going down, billionaires and hedge funds are making millions. How do these hedge funds manipulate markets? How can I tell when a market is being manipulated? How do I take advantage of these manipulated markets so I myself can make money? Well, those are all good questions, and it's exactly what we're going to be talking about. Let's get straight to it. Market manipulation, the act of artificially inflating or deflating the price of a security or otherwise influencing the behavior of the market for personal gain. There are tons of styles of manipulation, and the scary part is some of the ways are completely legal. The first style of market manipulation is one that almost everybody knows about, but it's important I cover it because you do need to know to the extent of what's going on. News manipulation.
I saw it on the news, Cal.
This is one of the most common types of market manipulation, and it's happening almost every single day right in front of your eyes. You getting on your computer, going on Reddit, and making up a story and creating a thread of why company XYZ is such a bad company is market manipulation. You being down 30% because the stock you recently invested in went down, then you thinking you can go on StockTwits and make a false story so others invest in that company is market manipulation. But this is purely just level 1 for market manipulation, and is usually a lot easier to spot than higher levels. Hedge funds will use techniques that are a lot more subtle and harder to spot. So let's say there's $1 billion hedge fund. It wants to buy a ton of shares from a company that's $20 per share, but they think it's worth $40. The thing is, they can't just go out there and accumulate millions of shares all at once, because it would affect the market drastically, making the price have a huge spike. That's the one thing these massive investors and hedge funds have to think about all the time. Since they're dealing with huge amounts of money, they not only have to think about company valuations, but also how their entries will affect the market. This is usually how the strategy goes. When the market of a particular stock that they are targeting is very weak, the hedge funds will slowly accumulate shares. They do this in sessions, not all at once. This way, they still get the huge amount of shares they want without affecting the market too much. Let's fast forward in time and say that specific stock they invested in is now worth $40. The hedge fund knows that this company is not that good, and a $40 stock price is pretty much as high as it's gonna get in the near future, so they want to exit their position. Unlike you and me, where we can simply just sell our shares right then and there, hedge funds again have to do a more advanced approach. They have so many shares that there are simply not enough buyers to fill all their sell orders at the specific price they want. If they want to sell all their shares at a high price, they're gonna need more buyers. So how can they dump millions of shares of stock at a great price unnoticed in a few weeks and get away with it? Manipulation. This is how they do it. But first, let's go over this video's sponsor,
Capitalize.
Now, I know what you're thinking.
Oh no, not another ad.
But this one may just help your investing game. So as we all know, during the making of this video, the stock market is going down. Instead of trying to figure out the exact bottom, a great strategy for long-term investors is dollar cost averaging. It's basically when you invest a fixed dollar amount on a regular basis, regardless of what the current market is doing. Capitalize can automate this process for you by making an automatic trading bot. Just simply go to the strategy creator, type buy 5,000 USD worth of Apple after 30 days from entry starts, then set the strategy on a loop. And every 30 days, the bot will automatically buy $5,000 worth of Apple. It's really that simple. And this is really just the tip of the iceberg with this. You can code any bot you would like and it can get extremely advanced. And the best part is you don't need any coding experience. If you're interested in creating a bot, I'll leave a link in my description. Back to the video. So we went over how the average investor would manipulate the market, but how do hedge funds manipulate the market? They do it the same type of way as you and I would in the example I used before, by going on Reddit and giving a fake catalyst, but they sort of have a billionaire version of it. They do have the same idea though. Create some FOMO, fear of missing out, and get people to think that this $40 stock is gonna be the next Amazon. They're gonna make you think that if you don't enter right at this very moment, you're gonna miss out on huge gains. Except instead of just making a little post on Reddit, they have a greater source to spread misinformation misinformation: news outlets. When the pandemic hit, it was a huge hit to the economy and a lot of media stations. More than 70 local news outlets closed due to the crisis. It's an estimate that a staggering 2,100 newspapers, or 1 in 4, have closed in the US since 2005. But as all this chaos breaks out, hedge funds and private equity firms look at this as an opportunity, buying up all these dying news outlets and using them to send out catalysts for their own investments. Hedge funds or private equity firms now control half of US daily newspapers. And you know what they do with them? Spread FOMO. This almost acts as a snowball effect. Think about it. The huge media outlet creates the FOMO story. Then, all these retail investors jump on the bandwagon, creating almost a snowball effect. In a way, the retail investor is doing all the work for the hedge fund, because after they enter their position, they start spreading the FOMO news themselves to all their friends or even the internet, because they want the stock to go up from where they entered. And it basically just keeps getting recycled from one investor to the next. All this news is going to bring huge amounts of volume, so the hedge fund can sell their position as quickly and, most importantly, at the price they want. They don't care if the stock goes up 20% from all the fake news. They really only care about exiting their position at this point. And guess what? When everyone starts to realize that this company is not going to be the next Amazon, the hedge fund is already out of their position and made a huge amount of profit, while all the other retail investors are still in their position and got burned, losing tons of money. But this is not the only type of manipulation. Oh no. There are much more slimy and dark techniques that firms use. One of them is what we're going to call the pump and dump.
You know, a lot of times when I was short at my hedge fund and I was positioned short, meaning I needed it down, I would create a level of activity beforehand that could drive the futures. It doesn't take much money. Similarly, if I were long and I would want to make things a little bit rosy, I would go in and take a bunch of stocks and make sure that they're higher, and maybe commit $5 million in capital to do it, and I could affect it. What you're seeing now is it probably is bigger market now. Maybe you need $10 million in capital to knock this stuff down, but it's a fun game and it's a lucrative game, and you can move it up and then fade it. That's often creates a very negative feel. So let's say you take a longer term view intraday, and you say, listen, I'm going to boost the futures, and then when the real sellers come in, real market comes in, they're going to knock it down. That's going to create a negative view. That's a strategy very worth doing when you're valued on a day-to-day basis. And I would encourage anyone who's in the hedge fund game to do it, because it's legal,
right?
And it is a very quick way to make money and very satisfying.
Instead of like the previous example where the hedge funds are worried about their entry affecting the market, in this example, they do it on purpose. They enter such a large position where it can actually affect the market and basically make the chart look good, making other investors roll in, while the hedge funds exit. One of the most well-known and popular versions of this was with Jordan Belfort and The Wolf of Wall Street, where he would get investors to invest in really crappy companies that were really overinflated, and he would sell into them, making millions of dollars. So how can you tell when a market is being manipulated like this? Well, in the 90s, it was a lot easier to spot, because private equity firms would just invest tons of money all at once, creating huge candles like this. But hedge funds nowadays are getting a lot more sneaky and creative to create these pumps. What they will most commonly do is what's called wash trades. Wash trades are basically trades that will cancel each other out to artificially create volume. So what these hedge funds will do is go to one broker, buy 500,000 shares, then go to another broker and sell 500,000 shares, canceling the orders out. So they didn't lose or make any money, and they aren't risking any money either. Where in the 90s, if a hedge fund artificially made the price go up by investing a ton of money all at once, there is risk involved, because the stock could potentially drop right after they entered. Using this technique, they have no risk whatsoever, but still have the ability to manipulate the market. How so? Well, when you buy 500,000 shares, then sell 500,000 shares, it won't move the price, but what it will do is create huge amounts of volume. And as we all know, tons of scanners and indicators use volume as an important metric. So whenever volume has a huge increase, that's just more and more investors seeing that specific stock on their watch list. And what happens when a ton of investors see a stock on their watch list? More activity, creating even more activity, and more activity, creating another snowball effect. effect, pumping the stock up. So hedge funds manipulated the market by artificially creating volume to get it seen by many other investors. And at this point, the hedge fund is already in a position, but they let the retail investors do all the work for them, so they don't have to risk as much, which is a pretty common trend with most of these manipulation tactics. They almost start to push the snowball down the hill, then let the others keep rolling it, taking all the risk. So how can you tell when this type of manipulation is happening? Well, it's pretty simple actually. Let me show you. If you ever are looking at your chart and you see a huge amount of volume coming out of nowhere, creating a new crazy high for volume, but then you look at the candlesticks and the price really wasn't affected at all, and there's just a really small candle sitting there. This, more often than not, is a hedge fund or firm trying to manipulate the market. I should also be clear, just because this happens doesn't always mean the market is going to go up every time. Sometimes investors won't take the bait and the stock won't move at all. But it's important to have this in the back of your head when trading. If you see a huge amount of volume come out of thin air and there's just a small candle, it's a good chance there's manipulation occurring. And the scary thing about this type of market manipulation is that it's completely legal. Has this ever happened to you? You're in a position with a specific company that you really like. They have nice earnings, good management, and the chart looks really good. You set your stop loss pretty low, so it doesn't get stopped out. But at the same time, you want some type of protection if the stock randomly decides to drop a huge amount. Well, fun fact, a lot of traders are doing the exact same thing. You get on the next morning and see there was a huge drop in price, where the price dropped a ton, hitting your really low stop loss, making you sell all your position. But right after the price went below your stop loss, it bounced right back up to where it was before. You check your news screener and there was no bad news or any reason for the stock to fall. It just randomly fell out of nowhere. You're extremely confused. This, more often than not, is a form of market manipulation. Hedge funds have a lot of information that the average investor doesn't have. One of them is they can see exactly where everyone's stop losses are. What hedge funds will normally do is create a huge short position, making price fall a pretty decent amount. But most importantly, what they're doing is if they see an area where there's a huge amount of stop losses, they'll do everything within their power to get the price down to those stop losses. Once they do, the stop losses do the rest of the work for them, just adding fuel to the fire and making the price go down even more. Once it reaches the bottom, they exit their short position and enter a long position, while the market heads back up towards where it was before, letting them profit from both a short and a long trade. Now, what's so scary about this type of manipulation is that it's very hard to predict. It can happen at any time, and you can't really tell when it's gonna happen. And sadly enough, there's not much you can do here, other than not panic sell or not initially staying in a trade too long. There's not much else you can do, which kind of sucks, I know, but there is some sort of way you can tell when it's happening. It's almost the exact opposite of the pump example I was talking about before. If you see a huge red candle, but there is very little amount of volume, these are some of the characteristics of market manipulation to the downside. After the whole GameStop and AMC situation, market manipulation is at an all-time high. And it's not because more and more hedge funds are doing it. It's because of you, the average investor. After the GameStop situation, retail investors started taking the strategy of just blindly following random traders and news. What's happening is big institutions are paying influencers, using bots, or media companies, and making companies look much bigger than they really are. The problem is, a lot of people nowadays will just trust another person's due diligence and just blindly follow them. What's even worse is after they enter the trade, they end up becoming an extremist about the stock and start spreading fake news themselves. And the only way you can avoid this is by doing your own due diligence and research. It's the only way you yourself can make sure to stay safe and know in the back of your head, no matter what happens, you know this is a good investment. It's almost impossible to completely stay away from market manipulation, but there are some practices that can improve your chances of making sure you don't get affected by it as much. Don't trust anyone. Not me, not a guy with 1 million subs on YouTube, not a random person on Reddit. Do your own research. You can only trust yourself. I'm not saying don't follow anyone, but if somebody says a stock is good, you can use it with a grain of salt and do your own research. If you see a lot of people saying a stock is going to go up, stay away from it. Look for the volume patterns like we talked about before. It can be a great way to see if manipulation is occurring. Sell the news and sell the hype. Don't stay in expecting the stock to go up after the news. If you try to do these things, you won't completely avoid market manipulation, but you will definitely decrease your chance of being a victim of it. Now, don't get me wrong, market manipulation is not always a bad thing. If hedge funds can make money from it, so can you. And you probably already have. It can be a good generator of money, but it's also a risky one. And as we all know, we want to limit our risk as much as possible. So maybe you don't take my advice at all. Maybe you still want to blindly follow others and try to make money that way. You do you. But I think it's important to note that all of you should know what's actually going on in the market, and you should know in the back of your head what's happening. In the end, it's your decision on what you will do. But it's important to stay informed. If you want to learn how to predict markets and predict which way the price will go, watch this video where I go over tons of different candlestick patterns that you can use to help predict which direction the market will head. Thanks for watching, and I'll see you guys next time.